Alright, so today I wanted to make a video on what I believe are the top Canadian stocks. Again, I think that there is some other ones out there that are good. So I have 6 in total. I think I have 3 that I would consider honorable mentions, and then 3 that I think are the best of the best. Again, as a Canadian, the U.S. is where it's at as a whole when it comes to stocks, but Canada does have some hidden gems, I think is the best way to put it, and I'll get into that as we go. So the first one is Go Easy. Again, this is one that, of all the positions I own, this might be the one that I'm up the most on personally. I bought it right around $90 when it had its big dip. When even was that? That was in early 2023. It got down to, looks like, I think it was 88 and change. So I got it literally within $1 or $2 of its low. It's back up to the 160s. It was above $200 a share back in 2021. That definitely was overextended. But again, I think that this is a really solid company. The one thing that concerns me a little bit is potential regulation down the road, because they make a lot of their money on lending, like lending at very high rates, I guess, for lack of a better way of putting it. Subprime, if you want to put it that way. And that's something that the government easily could regulate, especially with people. There's no shortage of people out there that have spending issues, which again is why it concerns me. Now, again, the real solution is not the government to swoop in and solve people's bad decisions, but again, that's typically how the government works. But again, $2.6 billion company. They currently have a dividend yield a little bit below 3%. Earnings yield of 9%, just over 9%. This is a company you're buying primarily because of the dividend, I believe. They've grown their dividend 33% per year over the last 5 years. Again, if you would have bought this company 10 years ago, you would have a dividend yield on cost roughly of 26%, which is just absolutely crazy, crazy good. Even if we go back 5 years, it would be roughly, it's a little bit higher than that. We're looking at roughly 9%, a little over 9%, which again is just crazy good. This company's grossly outperformed the S&P. They're up about 1,000% over the last decade. If you go back 5 years, they're up roughly 250% compared to the S&P 91. So they've always easily beat the S&P. I don't think that that's going to happen over the next decade. I think they probably will outperform, especially when you account for dividends. I think they definitely will. The problem is I think you're going to get some diminishing returns. But again, I do still think this is one of the best Canadian companies out there. They've always done well. They continue to always do well. And I mean, if you look at their current valuation, they are actually a little bit below their historical 5-year PE. But like I said, in 2021, they were clearly overvalued. So if it pulled back, let's say below, I mean, personally, I would, because it's already a decent sized position for me, I would want it to pull back like 15-20% probably. But if you don't have a position, I would say probably below 150, for sure 140. That's where I would look at it. Probably the 200-day moving average is where I would start to pick it up. So again, you're definitely going to need to see a little bit of a pullback here. The next one is CN. Again, this is a company I've talked a lot about before. This one, again, a little bit different in that this is a company you're buying for stability and diversification. And to a large degree, this company has a very, very, very strong moat. Between them and CP, no one, at least it is extremely, extremely unlikely, anybody will ever be able to develop a competing railroad in Canada. And the demand for their services is not going away. So based on those two facts, it would be very, very hard for this company to not perform at least decent in the future. I don't think you're going to get crazy returns off a company like this. But given how strong of a moat it has, I think you're crazy to not want a position in it. Again, if we look at its dividend here, they're growing at 9.5% a year. And again, it's currently just below 2%. The payout ratio is 38%. So they got quite a bit of room to grow it. Again, for how boring this company is, they've always traditionally outperformed the S&P. Over the last decade, they outperformed it by a little bit. If we go back about 5 years, they've actually underperformed, right? So, but again, 5 years, honestly, in the investing world, isn't that long of a period of time. If we go back even longer, they've outperformed it. If you go back to 2009, so again, about 15 years, they've also outperformed. This is a company that probably roughly keeps pace with the market, but I think will do it in a less volatile manner and a more predictable manner. So again, that's why I like CN. The next one, Constellation Software. Again, this is a completely different company. Again, a software company. They're a very, very good company, right? They're profitable. They've provided very consistent returns. Management does a great job. The one problem right now, they are expensive. So keep an eye on that. They're definitely expensive. And honestly, I'm kind of kicking myself because I remember seeing this company at like $1,900 Canadian and thinking, oh, well, I'll wait for a little bit of a pullback and then I'll get in. And that was right before, basically probably like a year ago or a little over a year ago. And it's run up massively since then, right? Just absolutely massively. And it's never came back, right? I mean, 2022, the lowest it's been in the last year is 2263. I mean, 3 years ago, it was as low as 1,700 at points, 1,800. Yeah, I mean, that was honestly right where I was looking at it. Like, hey, I'll wait for it to come down a little bit more, which, looking back, was a bad idea. But I never would have took a massive position regardless. But nonetheless, I think this is a really good company. If you see a pullback, I mean, where's it going to have to pull back to become reasonable? I mean, a price to free cash flow of 34, PE of 105. I would say probably at least 10%, probably 15 or 20%. So you would need it to come down to like the mid to high 2000, like the mid 2000s for sure. Like 2,500, that's when I would become really interested. Maybe 2,800, that's when I would start to become interested. And that's probably not going to happen anytime soon. So those are the first three. Again, the more of the honorable mentions. The first of the top three, Alimentation Couche-Tard. Again, this one is an absolute no-brainer. Just absolutely very, very phenomenal returns. I mean, let's just take a look at the returns of this company. Again, over the last decade, 526% versus the S&P 198. Over the last 5 years, 91 versus 84. So again, a little bit more even there. But again, over the long run, the chart emerges even more. Again, the dividend, they're growing at 28% per year. Payout ratio is only 0.84%, but the payout ratio is only 16. Like that signals that, hey, they're going to keep growing this very, very, very good over the long run. Everything about this company, not literally everything, but virtually everything about this company I like. They're buying back shares. They're profitable. They're in more of a boring area, but those are the areas where typically you find the most value as an investor. The high growth, AI, tech stuff, that's a lot harder to find value. Stuff like this is a lot easier to find value. And that's one of the main reasons I'm interested. So they are a little bit above their historical valuations. That's something to keep in mind, that they do look like they're a little bit overvalued where they're at right now. But again, just wait for a pullback. There's going to be a pullback at some point. I mean, the 52-week low is about $60 a share. 87 is the high. I mean, if we go back, I mean, just look at the chart for this company too. I mean, it's just a consistent stair-step higher. There's never a prolonged correction. I mean, there was back in 2008, but I mean, how long ago was that? So that's what I like about this company. I mean, if it pulls back, if it pulls back to the 200-day moving average, that's when I would just pile more. I would get as much more in as I could. Again, my opinion, but again, that is just what I'm thinking here. And I think they still have a lot of room for growth because they're growing into other countries. They're growing into China, Belgium, Germany, Luxembourg, Netherlands, Poland, Hong Kong, like the Baltics. Like look at, like, they're in Canada, obviously, the US. So again, they still have a ton of room to grow. So again, that's why I like this company. The next one this one's probably the one I like the most, where the shares are at right now out of all of the companies that I mentioned, and that's EQ Bank. Now again, they are near a 52-week high. I mean, they're actually a little bit off of it, $97 a share. It's currently at about 82, but if you look at its PE here, it's just below 7. Below its 5-year average of 8. And that's still cheap in my opinion, because if you look at the big 5 banks in Canada, I mean, especially like TD and RBC, they're trading around 10, 11, 12. And I think that this company is better than them. I think they're going to grow quicker than them. So I think that this company is it's definitely worth over $100, probably $110, $120 a share. And it's currently at 82. So I think you're getting this company at a clear discount where it's at right now. Again, the growth is phenomenal here. You have like growth, like tech stock numbers here from this company. The dividend, they're growing at 21% per year. The payout ratio is still 13. Right? The profitability is very good. Management's doing a very good job. If we look at, like I said, look at its dividend here. Again, it's just below 2%, but they're growing that 21% per year, which is very, very good. If we look at its earnings yield, 14.5%. That means that they could be paying a 14% dividend if they wanted right now. So they not only are they going to have room to grow that dividend, they're going to have room to reinvest a lot into growth. And look at how well it is growing here. If we look at its net income or earnings, look at how well it's growing over time, just absolutely phenomenally. So again, I think this is just a no-brainer stock right here. The last one is one that I mentioned before recently, Dollarama. I really like this company. Again, another fairly boring company, but again, look at just how well it has done and how well it will continue to do. Again, another dividend growth company. Again, only a dividend yield of just 0.27%, but they're growing at 12% per year. Look, it's easily outperformed the S&P over time. The payout ratio is only 8%, right? A free cash flow yield of 4.1%. Again, they're basically a glorified like value grocery store to a large degree, so they're not going to have high margins. But again, look at how well they've grown over time. And this is an area that I think is very underrated going forward. Again, with inflation being an issue, with cost of living being such an issue, this is a company that's going to benefit. And we've seen just that. And not only that, look at the crazy amount of shares that they're buying back every year. Right? 10 years ago, going into 2014, they had 432 million shares outstanding. 2023, 291. That's like what? 35, like 30% of their shares outstanding they've bought back in the last decade, which is just phenomenal. So again, I think that this is a very, very good example of a good value company. So anyway, that's what I wanted to bring up today. If you liked the video, please hit that like, subscribe, comment, all that good stuff, and stay tuned for more.